I'm telling you first, if no one else is telling you, this is not people buying gold because the Fed's going to ease. This is people buying gold because they want the gold. If they were buying gold because the Fed was going to ease, they'd be buying silver too. Silver's an economic metal. They're buying copper. They're buying gold. They're buying copper for economic reasons. They're buying gold for monetary reasons, and silver just started to catch fire last week. So why are these metals being bought? It's all central bank and Far East buying.
Gold prices reached another record high on Monday, driven by expectations of U.S. interest rate cuts and the metal's status as a haven asset. Spot gold rose by 0.3% to reach $2,240.04 per ounce. Joseph Cavatoni, a market strategist at the World Gold Council, described the current gold market as exciting, attributing the surge to growing confidence among market speculators in potential Federal Reserve cuts. However, VinceLanci, a market trader, criticized Western journalists for attributing gold market movements solely to actions by the U.S., particularly the Fed. He argued that such narratives overlook the influence of other significant players, such as central banks in different countries, in shaping the gold market. Cavatoni noted that the gold rally had been fueled by solid purchases from central banks worldwide, seeking to diversify their reserve portfolios amidst geopolitical risks, domestic inflation concerns, and weakness in the U.S. dollar. China, in particular, has emerged as a leading driver for consumer demand and central bank gold purchases, according to data from the World Gold Council. A Bloomberg report mentioned that gold's gains were tempered after reaching an all-time high as traders reassessed the Federal Reserve's rate-cutting trajectory following solid U.S. factory data. The report suggested that the rally in gold might be influenced by expectations of Fed easing. However, Vince expressed skepticism about Bloomberg's analysis, arguing that gold's surge is primarily driven by other factors, such as geopolitical tensions in the Middle East and Ukraine, and significant buying by central banks, especially in China. He disputed that bets on Fed easing were the primary driver behind gold's recent gains. Come along as we explore the valuable insights provided by VinceLanci. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
Are banks buying dips now? That's a question I asked myself this weekend when I was looking at the commitment of traders and the CFTC analysis. And the answer is probably yes. I've been saying there's been a big buyer for months, but the buying has kind of changed. Starting in that daily, I'll pull that daily chart up a second, but there's a daily chart. I kept saying there's a ledge here, it keeps getting bought. And I'm like, it doesn't make sense. Central banks wouldn't be buying at this level. They would be even more patient. I'm like, discretionary funds could be buying them, but they've already bought it. I think the banks are buying it. I'm not sure. The next question, right? In my head, are they getting long or are they covering shorts? It's probably a little bit of both, depending on the banks and how much in the know they are. So let's take a look at that a little bit. All right, first thing, just to get this out of the way, just because I saw this and it just blew my mind. Bloomberg's this morning, Bloomberg says those bets on Fed easing are juicing a rally in gold, which hit a fresh record. Bullion jumped to as much as $22.65.73 an ounce on Monday, up 1.6% from Thursday's close after setting a series of peaks in recent sessions. A host of other drivers have helped push up the metal by around 14% since the middle of February, including elevated tensions in the Middle East and Ukraine and strong buying by central banks, particularly in China. There is nothing in that statement that isn't correct. The lead sentence, I'm telling you first, if no one else is telling you, this is not people buying gold because the Fed's going to ease. This is people buying gold because they want the gold. If they were buying gold because the Fed was going to ease, they'd be buying silver too. Silver's an economic metal. They're buying copper. They're buying gold. They're buying copper for economic reasons. They're buying gold for monetary reasons, and silver just started to catch fire last week. So why are these metals being bought? It's all central bank and Far East buying. China's going to stimulate. That's what that bazooka post is I have there. Anyway, so there's nothing wrong with what they're saying there. It's correct. But look, anytime you're reading a Western journalist, they're going to tell you that whatever's happening in gold, if it's going up, is because of something the US is doing. If you can't keep the price in gold in check, blame it on the Fed. Don't say that there's anyone else out there in control.
The price of silver opened at $25.15 per ounce, marking a 1.62% increase from the previous day's closing price and a 5.13% rise since the beginning of the year. Silver's performance over the past year saw its 52-week high hit $26.13 on May 4, 2023, while its low dropped to $20.69 on July 26, 2023. Vince highlighted an observation suggesting that the GDX, VanEck Vector's Gold Miners ETF, and silver are at a pivotal point, indicating that a significant move is likely imminent. Gold has seen sharp advances in recent sessions, extending its streak of new all-time highs. Momentum indicators indicate overbought conditions in the gold market. This surge in gold prices has been driven by escalating geopolitical tensions, mainly due to the ongoing Russia-Ukraine conflict. Investors seeking refuge amidst these concerns have turned to gold, drawn by its perceived stability as a safe haven asset. Vince further asserted that significant movements in the gold market typically only occur with the knowledge and influence of institutions like the Bank of International Settlements. This implies that institutional actions and decisions could be pivotal in shaping gold market dynamics. Let's get back to the interview.
Moving on to the GDX, Van Eck Gold Miners ETF. I like this analysis. GDX, for this momentum chart, we'd specified that a monthly close for March at 31.55 or higher would do. So in the final hours of the month, GDX got above 31.55 and hung in there to close at 31.62. So it's on for GDX. It's interesting that GDX and silver are, call them both on or call them both on the cusp, right? So this would be do or die. I wouldn't say die. I would say this would be do or keep your powder dry again this week. So I would be very friendly. By the way, the only data you have to worry about this week really is Friday, non-farm payrolls. All right. Relative performance, an interesting one that everyone's talking about. Relative performance of gold miners versus gold. We specified a monthly spread close for March at 1.46% as a breakout. There was a sharp gain this month in the spread, meaning in March, but the close was at 1.426%. GDX's price expressed as a percentage of gold. So you see a downward slope there. So basically, the GDX versus gold relationship is at resistance, right? Right. And by the way, if miners don't perform today and gold stays up $13, $15, $20, well, that resistance is failing. So, that's the point. You want to see the GDX move with gold, right? Now, you don't want to just see gold move anymore. And that's why he's giving you the line in the sand. Silver as well, 25, 26. So really everything is on the cusp. So if you're naked long gold, right, and you're a relative value player, sell some gold, buy some gold stocks. I'm not telling you to do that. Just hypothetically, that's how you do it, right? If you're naked long gold and you don't want to deal with miners, well, you should just sell some gold and do nothing. On the other hand, if you're flat and you're looking to do something like, gold's really high, I don't want to buy it. Yeah, you should do hypothetically like I did last month. I bought miners when Druckenmiller announced. I'm like, Anyway, so that's the insight. There's a lot more on that, as well as our own insights, which goes to the point the banks buying the dip, and I'll show that on a chart in a second. But right now, I think the banks are playing this from the long side. And the most important thing about this whole meta-analysis I'm giving you is this. Gold doesn't do what it does without the Bank of International Settlements knowing about it. They didn't let it happen here. Sure, I'm talking about. No, you're not allowed to go up. No, you're not allowed to go up. I mean, these are significant levels that we had here. Maybe it shows up on a weekly. You or me here. Yeah. They're letting this happen. I mean, the forces in the market are bigger than the players in the market right now. That's what's going on.
In a recent interview with Kitco News, one market analyst emphasized that the gold market displays remarkable resilience and strength amid global uncertainty. Given the prevailing conditions of uncertainty, the analyst advised investors to anticipate that this robust trend in the gold market will persist. Do you share the outlook for continued strength in the gold market? Share your thoughts in the comments section. If the video resonates with you, Join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.